A single apple can spark a thought. I'm Edwin.
In the previous episode, we explored why gold and silver became money for thousands of years. For most of human history, monetary systems were closely connected to precious metals. Paper money existed, but in many systems it was ultimately understood as a claim on gold or silver, or at least as something supported by the promise of convertibility. In other words, the true foundation of money was still metal. But over the past 2 centuries, something fundamentally changed. Today, almost all currencies in the world are issued by central banks, and modern money is no longer directly tied to gold or silver. Instead, it is based on sovereign credit. So how did this transformation happen? To answer that question, we need to look at the rise of central banking. The story begins in England. In the late 17th century, the British government was facing a serious problem. War was expensive, and the monarchy needed a reliable way to finance military spending. In 1694, the Bank of England was established. At the beginning, it was not a central bank in the modern sense. It was essentially a private bank that lent money to the government. But this bank had a very special privilege. It could issue banknotes. These banknotes circulated in the economy, and they were backed by the bank's assets, including government debt. This arrangement created a powerful relationship between the government and the bank. The government needed money. The bank needed state support and legal privileges. And over time, this relationship would reshape the entire monetary system. During the 18th and early 19th centuries, many banks in Britain could issue their own banknotes. But not all banknotes were equally trusted. The Bank of England gradually gained an advantage over other institutions, partly because it was closely linked to the government, and partly because its banknotes were considered safer. Then came repeated financial crises. When smaller banks failed, their banknotes could lose value, or even become worthless. But the Bank of England was increasingly seen as a more reliable institution. As a result, the government began granting it greater privileges. Over time, the Bank of England became the dominant issuer of banknotes and the core institution of the British monetary system. At this point, it was no longer just an ordinary private bank. It had effectively become a central bank. This transformation had profound consequences. Under the traditional gold standard, banknotes were supposed to be convertible into gold. This meant that the amount of paper money that could be issued was constrained by gold reserves. But once central banks gained control over currency issuance, the nature of money began to change. Even when gold convertibility still existed, the system was already evolving towards something new, a sovereign currency system. In this system, money is not valued mainly because of the metal behind it. It is valued because people trust the authority, credibility, and economic capacity of the state. Gold no longer served as the only anchor of the system. Instead, monetary trust increasingly depended on government credit, central bank credibility, taxation capacity, and the strength of the national economy. In other words, money was becoming less a claim on metal and more a claim on the state. The model developed in Britain gradually spread around the world. By the late 19th and early 20th centuries, many countries established their own central banks. Japan created the Bank of Japan. The United States established the Federal Reserve in 1913. Across Europe and Asia, central banks began to play a central role in controlling currency issuance and stabilizing financial systems. Even when gold convertibility still officially existed, the system had already changed. Currencies were becoming sovereign tokens. That means their value came less from the metal they represented and more from the authority and credibility of the state that issued them. Over time, this shift fundamentally changed the relationship between money and precious metals. After the Second World War, the Bretton Woods system attempted to preserve a partial gold anchor. Under this system, the US dollar remained convertible into gold for foreign central banks. For a time, this created an image of stability, but beneath the surface, pressure was building. The amount of dollars circulating globally was growing faster and faster, far beyond the gold reserves of the United States. The system had not fully broken yet, but the contradiction was becoming impossible to ignore. And then, in 1971, everything changed. The United States ended the convertibility of the dollar into gold. No gradual transition, no global consensus, just a unilateral decision. The world was shocked. Financial markets were thrown into uncertainty. Governments scrambled to understand what this meant, because in that moment, the foundation of the post-war monetary system was gone. This event became known as the Nixon Shock, and it marked the final break between the US dollar and gold. For the first time in the modern global monetary system, the world's key reserve currency was no longer anchored to gold. Money was now based on trust. Trust in governments, trust in central banks, trust in the financial system itself. But this trust is not abstract. It is closely tied to a government's ability to tax, to manage debt, and to sustain economic strength. This is why paper money can have value even without gold backing. Japan is a useful example. Its government debt is extremely high, yet the yen remains one of the world's major currencies. One important reason is that much of Japan's debt is denominated in its own currency and largely held domestically. Investors still trust Japan's economic capacity, institutional stability, and ability to manage its obligations. This underlying capacity is what sustains monetary trust. Without that foundation, trust cannot last. The rise of central banks transformed the monetary system in a fundamental way. For thousands of years, money was anchored in precious metals. But over the past 2 centuries, the system gradually shifted towards sovereign currencies issued by central banks. Gold and silver did not disappear, but their role changed. Instead of being the foundation of money, they became stores of value, safe haven assets, and reference points for judging confidence in paper currencies. Understanding this transformation is essential for understanding the modern financial system. It also helps explain some of the most puzzling phenomena in financial markets. For example, the long-term changes in the relationship between gold and silver. In the next episode, we will explore one of the most fascinating questions in monetary history. Why did the gold-silver ratio change so dramatically over the past century? And what does that tell us about the evolution of the global monetary system?